Well, hello, it's summertime 2026, and we've been through the first 6 months of the year, and just like usual, it's been lots of excitement in the second quarter here. So I'm Bob Thompson, got Martin Course with me again, and we're gonna have our quarterly commentary. A little bit different this time, though. We're gonna kind of talk about some of the value that we provide over and above, the managing of money. That's important, but it isn't necessarily the most important. And let's get into lots of different topics here. And I think it's one of the reasons that we limit the clientele that we have, because everybody has different goals and objectives. And that one of the true values is, does your portfolio reflect what your goals and objectives are? And we try to make sure we're doing that with each household that we have. So lots of things to talk about. We'll go through some of the values, and then we'll go through, I think, the market after that. Does that sound good, Martin?
Sounds great. Summer can be a slower time. It typically is for a lot of different businesses. And interestingly enough, a lot of our clients have been using this downtime to plan ahead and really engaging us. So it really hasn't been, a slower time for us. And I know in the past it used to be a certified financial planner, and you shifted your focus as the business grew and you switched firms. So can you touch on why you came to Raymond James in the first place?
Yeah, I've been in the business 30 years. Everybody kind of knows that now, but I spent the first 20 at, another firm, good company. But I realized over time that the business, should evolve, and that people's experiences and people's life experiences and people's goals and objectives and values and what's important to them should really be reflected in a portfolio. And what that means is they need some sort of holistic approach, right? Holistic meaning taking something over here and something over here and something over here and putting it all together to make a proper formula for financial success. So, that's why I came to Raymond James, what was it, 9 years ago now. Raymond James manages $2.5 trillion throughout the world, and lots of depth of teams of a trust company that we own. We have estate planners. We have lots of financial planners. We have very high level, kind of high net worth tax consultants. We have financial planners that just deal with charitable giving. So those are the main things that are important. And, we've talked a lot about the different things that are important to people as they've already achieved their money and want to keep what they have. And, just to review that quickly, it's wealth enhancement. How's my cash flow? Am I saving on taxes? It's wealth protection, right? Do I have enough insurance? Do I have a holding company to protect my assets, maybe? It's wealth transfer, right? How am I going to transfer these assets to my beneficiaries properly? And the last one is charitable giving. And we can talk a little bit about all those. But, those are all the kind of value that clients should get, other than just, the market's going up or the market's going down or whatever the case is, right? That doesn't necessarily get you to your goals and objectives.
Yeah, investments are only one piece of the puzzle. And you mentioned holistic wealth management because that's what we focus on. So, I really want to bring up, a slide here that focuses on, 4 areas. It really simplifies things. But the first one is retirement planning. And what does retirement planning mean to you?
Well, that I think you have to have a plan. I've been a pilot since I was 16, like a lot of people know. And we do something called a flight plan. And the reason we do a flight plan is so we know where we are, we know where we have to be, what our destination is, and we draw a line to make sure we get there. Now, a lot of times you aren't on that line. Most of the time you aren't. And why? Because the winds come up, right? Or the wind's blowing you to the side, or there's clouds in front of you, or bad weather, or whatever, and you get deviated off of that line. But unless you have a line, or in other words, a retirement plan, unless you know what the line should be, you're never going to get back to the line. You're never going to get to your destination. So that's the goal, is to get you to your destination, not necessarily in a straight line, because things don't work that way in life. Grandkids need houses, or you need to buy something for somebody, or somebody passes on and you get some inheritance, or you give some money away, or whatever the case is. But if you know where you have to be, and if you're on the right track to get there, then at least you can get back to the proper plan or the line.
Exactly that. Life is full of surprises, and that's why we often bring up a financial plan.
Mm.
Whether you believe you need it or not, I think it adds a lot of peace of mind. You
Mm.
know, we're always testing for factors like living longer, like increased health costs, or even inflation in general. But more importantly, we stress test in these plans. What happens if the markets crash 30% and it takes 4 years for it to get back up to break even? Of course, we're doing our part, but let's just say, this happened to you and you need to recover for it. You want to know what you can do in those instances to make sure that you get back on that line that you've spoken about. Um,
You know, Martin, that reminds me. You know, Mike Tyson once said a line. He said, "Everybody has a plan until you get punched in the face." And I thought that was a great way to do it. I mean, Napoleon could the same, I think, said something similar about battle. You have this great battle plan, and in the first 15 minutes, it gets thrown off, right? Because you didn't plan for what the other side's doing, whatever the case is. And that's why you have a plan that's flexible enough, but still, you can, quantitatively tell you where you're going to be.
no, and that's why, bringing that back up
Mm.
is why we have so few clients so that we can do complex plans to address all the needs that our specific clients have. Like, no two clients have the exact same situation. But unfortunately, in our business, with a lot of our competitors, they'll likely have the same portfolio, and that really doesn't make sense to us. And I think that's a good way to segment to the second piece, which is investment management. We always want our portfolio designed with their specific goals in mind, and also taking into account their specific risk tolerance.
Mm.
So I know that you've been a historian of the markets. You've even written a book. So how do we take investment management to the next level?
Well, I think something's really, really important that we don't talk about a lot. And I'll talk about our barbell approach and multiple streams and this sort of thing. But I think what's really important is that, retirement is not an age, right? Retirement is the age in which you can do whatever you want to do without having to worry about the money. And I think that's really important, right? So retirement can be 50 years old. Retirement could be 40 years old. But you continue to work because you say, I like working, I like doing what I'm doing, but I don't have to, right? So that's one of the goals, is to make work optional. And I think that retirement plan tends to do it. I have an 8-year-old, right? Declan's his name. And I said to him the other day, I said, Declan, tell me something about money. And he said, Daddy, don't work for money. Make money work for you. And I said, that's right, Declan. So I'm trying to teach him that at 8 years old, that, once you put enough money aside, that's called retirement. And if that money can generate the same amount of income that you made during your working years, then continue to work. That's great, but you don't have to if you don't want to. And I think that's really important. Secondly, onto the portfolio side, which you talked about, is, I was talking to a fund manager the other day, and he's averaged almost 15% a year for over 20 years. Which is pretty good rate of return. Very few people have done that. That's beaten most of the markets out there. But more importantly, he's achieved that without having any taxable distributions to clients. In other words, a client that held it for 20 years has made 15% a year and paid nothing back in tax. I think that's really, really important. So that's what I wanted to talk about, is tax advantage. And this is one of the values that I think we can bring to the table, that you can't write on paper, right? You can't say, oh, the market went up 15% and did you go up 15%, right? What matters is a lot of other variables other than that, including the tax that you pay. So in other words, I think if you were to ask most people out there what their greatest expense in life was, they would say, oh, my home, or my mortgage payment, or my cars, I bought too many cars, or my kids, my family, how much money I could have saved if I didn't have a family. So, but all those answers are actually incorrect. The greatest amount of money you spend on any single item in your life is on tax, right? And here in Canada, it's over 50% that you're going to pay in tax. You're not paying that on food or mortgage or anything like that. So it's important to at least put some sort of effort into saying, hey, we all got to pay some taxes, but let's try not to overpay too much because that's eating into my lifestyle, and what I can do for my family down the road. So tax advantage accounts are important. Paying attention to this after-tax income, and getting a 15% rate of return and paying 8% of it back in tax, you only make 7%, right? Getting an 8% return and paying no tax is actually a better return. All right. So anyway, that's important is to minimize the taxes, and we pay attention to that. It kind of fits into our into how we look at the markets. And you talked about how we talk about portfolio management with clients. Well, we try to get multiple sources of income or multiple sources of gains that are all uncorrelated with each other. And I think there was a hedge fund manager, right, Martin, that talked about that.
Yeah, Ray Dalio. We looked
Yeah.
at he ran one of the most successful hedge funds of all time, Bridgewater Associates, and he put out a great video in terms of how he looks at portfolio management. And there's no such thing as a bulletproof portfolio, but it's the closest you can get, right? And how did he come across this? He come up with a lot of different return streams that some are dependent on the market, some don't. Some depend on just consistent income. But when you put them together, you lower your volatility of your portfolio and you get a lot more consistency. And I know with our clients, because many of them have accumulated a lot of wealth, that it's important for them to preserve it moving forward. So having an approach like this really resonates.
Well, it's interesting because you can't quantify this, but there was a fund manager with Fidelity years ago, averaged 29% a year over 19 years that he ran money for Fidelity. And one of his famous quotes was, "You don't do well in investing with your brain. What's more important than your brain is your stomach." And what he meant by that is not selling at the bottom, right? You got to have a tough stomach. You got to be able to take the ups and downs of the market. The more ups and downs there are, the more you learn, the more you're probably going to stick with it. But honestly, most people don't do well in investing, not because the market doesn't do well, but because they do the wrong thing at the wrong time, because you don't know the future. You know the immediate past, but you don't know the future. So, if instead of kind of trying to hammer that into people's brains, it's really hard to do in times like '08 or April of 2025. What you can do is say, hey, we're going to have 5 or 6 different investments here, which might do the same return over time, but they do it in different ways. So when a really, really bad market comes along, you can look and say, oh, well, things aren't too bad. Some of it's up, some of it's down. I can stick with that. And the most important thing is, again, not picking the best stocks, not being in the best market. It's sticking with it through thick and thin. And it's really, really tough to do that unless you have some sort of portfolio approach. And that's what we're talking about here with the barbell approach. So again, that's a value that you really can't put your finger on, right? Can't put your finger on and say, oh, we were up 15% last year. Oh, let's look for a market in the world that was up more than that. Oh, the Finnish stock market, it was up 82%. Why didn't we have all our money there? Well, as you know, you can never know what's going to happen in the immediate future, but you can cushion the ups and downs, get to where you want to be with proper portfolio construction. And again, you can't put your finger on that value, but that's one of the big things that we're trying to do.
And we'll dive into more of our positioning. We've talked about it in previous videos, but just want to circle back on taxes.
Yeah.
Tax strategies are very important, and you mentioned a few, but we also have tax deferral strategies that we've done with clients. You have a large gain in one position. We can help you create income, diversify it out without paying tax right away. So that's very important. But the second one, which is, I think has more of an impact behind it, is strategic charitable giving. And we have that at the bottom there. And, if you do have a strong need for tax reduction, but also you have, the ability or the want to give back, then this could be something that's very, I think lucrative and beneficial for you. I know that at Raymond James, you could start your own donor advised fund, so your own family foundation essentially, for $100,000. And then you can grow capital tax free and use that growth to give every year. I know you've started one, and I was wondering if you
Mhm.
could talk more about your experience.
Sure. Martin, it was a couple months ago now. I was on a show with somebody named Daniela Camboni, and I think we sent out a video on that, but I highly recommend if you haven't seen it, ask us and we'll send it out again to you, or it is on our YouTube channel. But um, we were supposed to be talking about the markets, interest rates, and how the markets were doing. And we spent the first two-thirds actually talking about building family values, especially with your children. And, I think one of the reasons we got into that, I have an 8 and a 6-year-old boys. Daniela had two 6-year-old boys. They were twins. And, it kind of brought a tear to her eye. I was surprised as we were going through this interview, because I talked about how to build values and how to what's important in life. It isn't the success or the amount of money that you have necessarily. It's how you can pass on your values, how you can make people's lives better, etc. So we talked a little bit about that, and I told her, I said, one of the ways that I've done that with my kids to try to build community values and get them thinking about other people and helping is through this charitable fund, right? So the great thing about it, the donor advised fund, is usually, if you set up your own foundation, you have to have a board of directors, you have to have accountants and lawyers and tax schedules every year and report to the CRA and minimum gift amounts and all this sort of stuff. It's very complicated. You got to be an expert in it yourself. But with the donor advised fund, you don't. You just put the money in, and all that's taken care of by Raymond James or another donor advised fund. But I think what it does is it creates the same values with kids. So in other words, I put some money into that in my dad's name, and a lot of my clients know that my dad passed away 2010 now. And the boys, when we give money out, I get the boys involved. They're 8 and 6 now, and they're old enough to say, "Hey, let's help out somebody in Grandpa's name." And giving and making people's lives better is really important. And I'm trying to get them off the material part of it about what can I buy, and say, "Hey, instead of make you happy doing that, let's make you happy helping out other people." And the foundation is great for providing those values. Doesn't have to be with your kids. A lot of clients have older kids. It could be with grandkids, and you get them involved. Create your own little kind of informal board of directors, right? Where once a year or once every 6 months, you get your grandkids and your kids together and say, "Hey, here's some money that's going to go out. How can we help people? What should it go to? How can we make an impact in the community?" I think that's really important.
And that's one thing that we've studied before is, how do you input values into and education to your children, whether they're young adults, older, or quite young in your case.
Right.
It's never too late to start, and that's a critical part of estate planning. That's the last piece, and I know we discussed estate planning in quite detail last quarter. So we brought on Samantha Russell, one of our trust and estate lawyers, and she went through all of the services. But it's important to have a will. It's important to have a plan in place, not only with your own finances, but with your family, and how you're going to bequest that wealth to do it in an efficient manner so that it lasts. It lasts multiple generations, and we all have that power. It's just about, putting the time into it so that, you can carry out your wishes.
Right, right. Yeah, I think, it's something that people don't want to talk a lot of times, the estate planning side of it, but I'm in the middle of reading a great book right now talking about how to introduce your family to it, and how to, not necessarily tell everybody how much money you have in your family, but prepare people for that next step down the road, right? And preparing them for the fact that, hey, money can make money for you, right? You just have to preserve the capital. I know you haven't had the opportunity to make all the mistakes, the ups and downs, the 2 steps forward, 1 step back that I've done in my life to get where I am. But let's get you on the right track so you understand. And I think that's really important. That's why it's important to have some sort of family, discussions about it.
Yeah, perfectly said. So with that, we definitely want to bring in, jump into the second segment of our discussion, and that's to get into markets and investing. And the second quarter, it's funny, it's a little bit of deja vu this year. We had some volatility in the spring caused by one of our friends down south, and now markets have bounced back, but specifically in this year's situation, we've seen oil prices spike, and then we saw it fall in the second quarter. Markets rebounded because they thought these peace talks would stick. But now, what we're seeing over the last few weeks is oil is back to the upside. And we spoke about when oil was coming down how we're not really touching our oil positions. If anything, we'll look to add on it on weakness in certain client accounts. But we remain, bullish on energy, and we think, inflation is something that we should hedge.
But Martin, you're wrong. We've had 40 times now where we've had peace. So maybe the 41st or the 43rd, maybe that'll be the time in which we're going to have real peace. No, I laugh, but yeah, that's what's made it so stressful for people is back and forth, back and forth, back and forth. And sooner or later, markets break, right? It's like bending the fork, back and forth, back and forth. Sooner or later, it weakens. So that's kind of what's happening. Like you said, here's something I think is important just to talk about what you were just saying there, and that is, this is what people miss, and I think this is really important. So I'd highly recommend, remember this. Put it on your fridge. Markets are cumulative, and what I mean by that is I hear people say all the time, oh, this guy said the market was going to go down 2 years ago, and then he said it was going to go down last year. And so I don't listen to him anymore. The guy's always been wrong. Well, he was right 2 years ago, probably, in saying that the market was overvalued and it was dangerous, right? So if he's continued to say that and nothing's changed, then that's a cumulative effect, meaning we're a lot closer now than we were before. It isn't like an absolute, somebody's absolutely wrong, right? Markets cumulatively become more expensive, or they become cheaper and cheaper and cheaper, whatever the case is. So if all the things lined up for a market to not do well 2 years ago, and it still hasn't gone down a lot, well, that means the cumulative effect is that it's probably going to go down more and harder than it did before. And you know my famous analogy, right? Oh, I don't know if it's my famous one. I think I stole it from somebody. But it's bull markets are like a strong bull. The stronger the bull, the bigger the bull, the harder it is to kill it, right? But I think this is important. This is the cumulative effect that I've talked about. Each time you put a sword into it, or whatever the case is, the bull comes back at you again, and back at you again, and back at you again. But each time it comes back at you, it's weaker, right? Because it's lost more blood, or whatever the case is, right? Unfortunately, my dad took me to a bullfight when I was 10 years old, and it scarred me forever. But that's what they do in the bullfights, right? They actually, the matador comes out and does what he does with the bull. But the bull market keeps coming back at you, right? In other words, the market continues to go up, and the naysayers who say, oh, the market's going to go down, the bull market's not going to make it anymore, it keeps coming back at you. But remember, it's weaker and weaker and weaker each time it comes back, and one time it just can't come back anymore, right? And so that's what we've always got in our mind with the markets.
And unfortunately, what we've seen is for the majority of retail investors, you've seen them pile in at kind of the worst times. And they're always investing in the past. They're always looking at, the past returns, the past growth of these companies is so strong, it's going to continue. Well, like anything, after it doubles, it's a lot less attractive to people like us. And what I want to bring up is, we've seen a piling into passive ETFs. So a lot of people have been chasing low costs. Right. And what I want to bring up is this chart here, which is the concentration of previous bubbles. So it goes, approximately 200 years in the past. And you've seen different bubbles happen throughout stock markets or markets in general. And it started with railroads. It moved to, different pieces of technology that have changed the world in different aspects. So you had the industrials and utilities and telecoms, and later you had the nifty 50s. And of course we had the internet in the 2000s, and now we're having an AI bubble. The largest 10 companies now make up close to 40% of the overall S&P 500. And the funny thing is all the previous bubbles popped around similar levels, and that doesn't mean it's going to happen tomorrow or next year, but we are seeing other warning signs. And it's not just in the US, In the emerging markets, we see 3 companies make up 30% of the whole emerging market index. This is multiple countries that make up this index, and only 3 companies make up a third, and it's all tied around the same AI theme. So we don't think it's prudent today to buy index ETFs because you're basically owning very few companies with very high weights. So how do you think we should invest today, or how do you see that we have been investing for our clients?
Sure. The best offense is always the people who win the most games in most sports are the people who play the best defense, right? Spain just won the World Cup. You know how many goals they gave up in the entire World Cup?
4.
In all the games that they played. One goal. They shut everybody else out at 0. So you don't have to score a lot of goals if you don't let the opponent score any at all, right? You just have to score one once in a while. And that's the same with investing, right? Now, it's not as exciting, it's not as fun as chasing whatever your neighbor's buying, all right? But playing defense, not losing a lot of money, having a margin of safety is really important. So it doesn't mean you can't invest in things that are going to do really well. I mean, we, as you know, a lot of people know we invested in uranium stocks a few years ago, and you know, one of those stocks that we did is up 10 times. So it's not like we're trying to make money. We're trying to make money, but we're buying at the right price, and that's what gives you the margin of safety. Buying things that are unpopular, because you know, the more popular something is, the less chance of future gain. I mean, that's just a simple formula, right? So the more people are talking about a particular investment, the less chance for gain. So I know you're not supposed to make forecasts, but I will make a forecast right now that we hear things about AI every single day. I mean, that's all you hear about, right? So my forecast is AI will change the world. The world will look different in 5 years, hopefully better, as far as our access to information and all that sort of thing. But most of the companies will be bankrupt in the AI sector, right? That happened in the tech bubble. That happened in the railroads. It happened in the, even I'm not old enough to remember the railroad bubble, but I read about it. Or the radios, or the Nifty 50. You know, the Nifty 50 stocks, right, which you talked about. Those were the 50 stocks. They were the technology. They were changing the world as far as technology was concerned, right? So 2 of those companies I know were Polaroid and Kodak, right? Both of them are pretty much bankrupt now, okay? But those were the companies that were changing the world and had these excessive valuations not too long ago. So it's important to just remember that the world, the more people are talking about something, the less chance of gain actually that you have. So what that means is nobody's talking about anything that's going to happen 2 years from now. Everybody's talking about something that's happening now, or something that just happened, right? Oh, the stock went up 400% in the last year. I should look at it and maybe buy it. No, the time to look at it was 400% ago. And you can never pick the bottom. So if you're looking out 2 years, then at least you have a chance to add value and say, hey, you know, nobody's talking about this thing. We think it's going to be a great place to be. The timing you can never get right. But if it's a when question instead of an if question, then you just have to be patient, right? And that is proper portfolio management in our respect, right? Most of our clients have already made their money and want to preserve it, right? So you want to make sure it's growing for you, but you're not going to give it all back. And the way that you do that is you look a couple of years out, you say, what's maybe unpopular right now? Let's make sure we're making a good buy price. And then in the future, we're going to, you know, hopefully harvest those gains down the road, but it might not happen right away. You have to look wrong, or you have to take the risk of looking wrong. I think that's important. So as I said, price is what you pay, and value is what you get, right? Pretty much everything.
And that's why we focus on value today, right? And I think a lot of our clients resonate with this. We've heard it from a lot of our largest clients who are very astute and tied to the markets, that there's certain areas of the market that are, you know, very concentrated, which you highlighted before, that are quite frothy, that are based upon these high level of expectations. Well, when you have high expectations, and you always say the secret to happiness in life is low expectations. So a lot of people are actually employing the opposite right now. They're investing in things of very high expectations. And if you miss only a little, like Google today, they actually beat and had good earnings, but they actually burned money for the first time in a quarter in terms of they spent more money than they made. So the stock went down 6%,
Right.
and still a great company, but it's suffering. We'd rather invest in companies today with low expectations that don't take much to beat those expectations and you can do well. And secondly, we're looking to, hedge against some of these areas that we think that are, uh, you know, a little bit overvalued. So if things go the way that we expect them to, we expect a profit as well. But if we don't expect to be dragged down, we have a lot of different return streams, and we've been doing well with the positionings that we have. So, I know that you always look at the portfolio during volatile times. That's one of the things we both do. And what we've noticed is whether it's, I would say 3 years ago in 2022, or the drawdown last year or the drawdown this year, we've been very, very pleased at how well our portfolios have done. So
I wanted to add something to that too. We talked about buying with a margin of safety, buying when something's out of favor, and the buy point is the most important. You can make a lot of money in really lousy industries if you buy at the right time, right? That's what's important. The buy point is so important. But with I talked a little bit earlier about taxes, right? And I said that taxes kind of ate away at your net return more than anything else, right? So my famous saying of portfolio's like a bar of soap, the more you touch it, the smaller it gets. And that's because you're usually, with a high turnover like that, you're chasing returns, right? Which gives you a lower return generally over time. But it also gives you a much lower return because of taxation too, right? If you buy a stock 5 or 6 or 7 years ago, like we did with this in the uranium sector, and it's up 10 times now, and we haven't sold it yet, or we've just trimmed it a little bit, you haven't paid any tax on that money at all. You've deferred it all these years, and I think that's important. So this sort of approach is usually better from a taxable perspective. Also, this margin of safety sort of approach. I think that's important.
So we'll keep employing this. We'll definitely stay tuned in terms of what's happening. We are positioned in a lot of areas that we believe will do well, and some areas that we want to avoid. That's what we're doing. So with that said, we're going to wrap up our quarterly update. We thank you all for entrusting us with your wealth, and please reach out to us if you want to discuss this further or if you have any questions.
Thanks again, Martin. It was a lot of fun, and looking forward to September. See what the fall brings us.
Hopefully no surprises. We'll see. Take care.
All right, thanks.
Thanks, everybody.